Hi all, let's see here. Wow, we got a good number of participants coming in here. Good. Little agenda down here in the corner. People can see that, I hope.
Yes.
Yeah, so what we're hoping to do is to get Brian to talk about his results, the Lizard results from 2020. And then Steve had a couple of things that he wanted to talk about in terms of his volume trading. He has a strategy that he's trying to do to set up, make it robust, just looking at volume. And then we're going to go into the deep end of the pool. And I realize that not everybody is going to be into these esoteric option trades. I'm not going to go into explaining all the subtleties of options and the iron condor and all that kind of stuff. So if you have to have a basic understanding to go swim in this deep end. And I will, during that period of time, I've tried to set up some breakout rooms. So for people that aren't into the really esoteric stuff of option trading, particularly understanding what Vega means, stuff like that, they may want to go off into these other rooms and just have a discussion with fellow traders. So we'll see how that goes. I've never done a breakout room before, so this is another new experiment. And then hopefully we'll be able to reconvene and decide on what to do on Monday. So that's the current plan. I will Stuart, you're okay. You're jumping all over the place there, Stuart. I'm going to turn off your video.
Stuart, your video is distracting.
You got it. You got it.
Yeah. Okay. All right. So, all right. So I am going to stop sharing this, and I will turn it over to Brian Cox. I wish we would have his video running. I haven't seen Brian in a year. It really would be great. So here, let's see. I do have a little picture here. So here's the guy that you're going to be talking to, who's going to be talking.
That's a wonderful picture.
So we don't have a video of him, but I'm hoping that this refreshes everybody's mind, and we can go ahead and get Brian to present. I'm going to stop sharing, Brian, and I will let you take it from here.
Okay, let's see if I can bring this on. Okay. Okay, let me know if you can see it.
We got it.
Okay, great. And so this is my long-running Lizard stock portfolio. And just as a reminder, this is a club activity. We're actually a partnership, and we put all our money in and we meet once a month. Let's see. Yeah, okay. And so I'll be sharing the performance of the Lizard's portfolio for the last 18 months during the pandemic. Again, as a reminder, it's a stock club partnership that meets on a monthly basis. And the portfolio I'll be showing represents actual trade results. The trading philosophy will be discussed along with suggestions based on lessons learned. And specific techniques have been presented previously and are posted at the Excess Profits website. Okay. And so we will also compare the Lizard's portfolio to the performance of the S&P 500 during the same time. Okay, and so this is how we've been managing the portfolio for the past 18 months, which is pretty similar to the way we've been doing it up until now, which is in the last 18 months, we have continued to meet and trade only once a month. We've been meeting virtually, very much like this. And our standard process is that we look at each position, looking at the charts and determining whether it's time to move the stops up or not. Every single position has stops associated with them. Then after we do that, then we discuss any new candidate stocks, and on a 2-year time frame, using the TOTS charts, we look at it whether or not it has any potential. And then we look at it with my stock plotter, which is at charts.excessprofits.com. And if we want to include it in our portfolio, then we buy a position based on a constant risk approach. And then we also look at if any of the other stocks that we want to move up the stops, determine if we want to buy more risk. So after we move up the stocks, or the stops for the stocks, our risk has been reduced. And so we look at whether or not we want to buy more risk. That's part of the constant risk approach. Okay, these were the December 12-19 positions. It's kind of handy that I do these presentations because then I do these snapshots of previous positions. And so you can see this was at the beginning of December, the kind of positions that we held. And then these were some of the positions that we had sold at that point as well. Okay. And then the 2019 performance over the previous 7 years, you can take a look here. And the compound gain over 7 years was almost 200%. Not too bad. Okay, but when you compare it to the SPY, here's our performance of over 7 years, almost 200%. And here's the performance for the SPY, that if you had just bought SPY and held it for this period of time, after 7 years, you'd be up 120%. So that's not too shabby either.
Very nice, Brian.
Yeah. Okay. And so now we'll take a look at how, since the pandemic, how we've compared against the SPY as well. Okay. 1 second. Great. Okay, so here's our current portfolio, and these are the positions that we currently hold. And these are the positions in the last year that we've sold away or got stopped out at. You can see a bunch of them occurred at the beginning of March last year, and then we've had some others since then as well. Actually, these are more recent. Oh, these years, these should be 2021. No, 2020. These are right. Yeah, these dates are correct. Okay, and so here's the performance over the 9 years. You know, if we were to say that our date right now is the end, if you take a look at our 9-year performance, you can see that last year, because of the pandemic, we were actually down 8.5 or 8.7%, and that brought our 8-year gain to 180. And now we've sort of recovered. We're up about 10% on the year, and so that makes our 9-year gain of 209. And here's just a little plot of the chart. Okay, and so now when we compare it to SPY, is our, let's see if I got a highlight here. Yes, here we go. And so here's our current 9-year gain of 209. But if you just bought and held SPY, you're up at 191%, which isn't too shabby for not doing any work at all. Okay. And so in summary is that the stops in the large market downturn, the approach using the stops to exit positions worked as expected, took minor losses on acquired positions. And on re-entry, we re-entered positions that did not participate in the market downturn as soon as feasible. So as soon as the cap bounced and stopped bouncing, then we re-entered the market as we could. And so let me show you where some of these, 1 second. Let me show you some of the actual charts, because it's a little bit more interesting if we look at the stock charts. Okay, so these are current positions here on the left-hand side. And so let's zoom in a little bit. 9 months. Okay, and so these are some of our current positions. And as you know, the market's sort of going sideways at this point, at least the stocks we've owned. And so here's one called Digital Turbine that we own. And what these are, for folks that haven't seen this before, what these little lines on the bottom are representing or pointing to where our stops are. And the lines from the top are representing what we call levels of support. And so you can see at this point, we had moved the level of support up, and then we moved our stop here. And the stop is calculated by taking the level of support, finding the average true range, multiplying that by 2, and subtracting it from where we're calling support. And so you can see right now we're lower lows, lower highs, but we're not doing anything to actively manage this because we're expecting these things to go back around. Plus, we're comfortable with the loss if we happen to get stopped out. And here's some more. Again, moving sideways quite a bit. Here's one that gapped down below our level of support here, but it hasn't hit our stop yet. GNRC, this is a pretty neat company, but again, everything is kind of moving sideways. Here's another one. Another one. This one did a big gap, but we still haven't hit our stops yet. Here's SPY. We've actually bought quite a bit of SPY. Instead of leaving our money in cash in the account, we're using SPY to hold that, so that because the SPY has been going up pretty good the last couple of years, so we're using that to keep our cash in. Here's Square, and then here's Team. I'm waiting for Team to appear. Great. And so Team, like everything else, is moving sideways. But what I think is more interesting is what happened to the stocks that we stopped out at. And so I've got a little watch list here of the stocks we got stopped out at. Okay, and so these are some of the stocks we got stopped out at. And the question is, were they a good thing that we got stopped out of them? And so let's take a look. And so here's TDOC, which did really well at the start of the pandemic, but you can see that we ended up getting stopped out here, which is a good thing. It continued on down. So why would you want to hold on to it? Here we've got Tesla. We had some Tesla. I'm waiting to populate, but I think you'll find out, yeah, we got stopped out here, and it's just been moving sideways since then. So, you know, good that we got stopped out there. Here's TTD, which is Trade Desk. And so we got stopped out here, and it has continued to go down. So stops are kind of nice. It takes away that anxiety of should I sell, should I sell? And so once it occurs, then it's out of your hands. And here's another one, VEEV. I'm waiting for it to populate. And you see we got stopped out here, but again, it hasn't really done anything. So it's no great loss that we got stopped out of that one. And here's VIPS. And this too got stopped out. And again, it hasn't gone anywhere. So it's kind of nice that you have these stops that they mechanically get you out of the trade you're in. And in most cases, you'll find that it's a good thing that you did get stopped out, so that you keep from losing even more. So that's what we've been doing. Again, the returns aren't as good as we had expected, but that's the crazy market we're in.
Hey, Brian, have you ever done any kind of analysis of pullback depth? You know, how much money have you potentially left on the table? I mean, you got to have stopped some way, some shape or form. But did you ever do anything that says that, hey, you know, okay, I made 100, I made 70%, but then I gave back 50%.
Yeah, that's sort of what this chart here shows. This is where we got stopped at. You can sort of see what we've lost on those particular trades. Let's go to the more recent one.
But is that from the peak or?
No. Is that we define loss as the difference between what we bought it at and what we sold it at.
Got it.
We don't do the peak business because that's just, you're pounding yourself in the head for that.
Hey, that's
You
what I
know,
like to
if you,
do.
you know, I say I woulda, shoulda, coulda. I cannot play that game and still trade stocks. If you keep on looking at, well, I should have sold it up there. Well, unless you're running in some time machine, to me, it's a waste of time to actually do that.
Yeah, for me, it's
So to
more
answer
of
your question,
a
I haven't
tuning
done
the
that.
stops. For me, I
Yeah.
tune the stops, and I want to see how much I can maintain. And so it's a never-ending battle or a challenge, actually, to maintain stops that are, keep as much money in your pocket, less on the table. But
Mhm.
okay, it's interesting. It's a different take. Everybody's got a different take.
Yep.
Okay.
The woulda, shoulda game, I can't participate in that.
Yeah, I agree.
And
Good.
so what you see here, this is the current positions. These were the ones that got stopped out more recently. And you can see you're taking reasonable kind of losses. You know, you don't have any kind of loss that's huge. The only one that we violated was TDOC, and that's simply because I ended up fat fingering it and bought two sets of. I was supposed to buy 15 shares, and I bought 15, and I didn't think the order went through, so I added another 15 on it, and then it got stopped out. So that was a fat finger issue.
Yeah.
So Brian, so you missed the big downturn in TTD, I guess it's Trade Desk,
Mm-hmm.
because it went down like 25%, right? So you were out in advance of that, correct?
Let's take a look at, here's TTD. I got stopped out right here. So what's that, 3.5? And so here, this is this the downturn you were talking about?
Yeah, that's it.
Yeah, but you can also see, and you can also see our purchases. So you can see on the way up, we bought it here. Then, of course, a month later, we get this boom. Okay, what do we do, guys? Well, we have our plan, so we just stuck with the plan. And then we had a couple more downturns, and look, on this one day, ooh, and I took a look at that. That was like 5 minutes worth of activity that stopped us out of there. But you can see that the stock was weakening. It was coming closer and closer to our stops, and it just has not recovered yet.
Now, can you talk about the way you're getting into it, getting into the position? Because I didn't realize you were buying into it on multiple.
Yeah, that's the whole deal, is that we keep on buying in on multiple, and the way that we do it is simply that we'll look at a position. Yeah, I might as well use this one for an example. But all we do is we look for the series of support lines, and we'll find this one. Let's go right here, because this was a time we actually bought it. And so what we could see is that we had drawn a series of support lines. And so what we're looking for is two areas of support. So this didn't seem very strong to us, but this one did, because it bounced off of here. And this area looked like it was fairly strong because it broke through. So we call that we were buying with this area of support. And then our stop was 2 times ATR minus that support line. And that's how we come up with that stop. And so if you look at the previous buys, the stock went up, we bought some, the stock went up, we bought some, the stock went up, we bought some. And so after a while, you're accumulating quite a bit of stock on some of these positions. And when you sell them all. So in this case, it was, we bought these and we sold 7.
Gotcha.
Yeah.
So I'm sorry, can you describe a little bit more how you're deciding to buy more TTD instead of something else?
Yeah, well, yeah, let's go back to that presentation. Let's see.
Because the thing that I get
Yeah.
sort of tied up with emotionally is that I think I don't want to buy more because I'm sort of getting to the party late. And so I don't see any more upside, where I'll buy late just as it turns down. And if it turns down and I bought it at a real low rate, it doesn't matter because I'm just giving back a little bit of the money. I didn't pick the top. So anyway.
Yeah. Yeah.
But go ahead,
Well,
I'm sorry.
Yeah. So basically what we do, this is our standard way of doing it at each meeting. First of all, before we do look at any other potential stocks, we look at our current positions and we move the stops up as required. So if the stock has gone up and we can find a new support line and find then we'll move the stop up. And then after that, then we'll have people bring to the table any new candidate stocks that they want. And we draw most of these off the top 50 report that comes out once a week that I generate. And so we'll look at those, and we'll look at those both on the TOTS charts as well as this chart down here. Let me show you what this one looks like. Oh, make a copy. Okay. And so on a chart like this, and I created this just because, I'm kind of frustrated that most of the stocks here, you look here and you see them growing, but it doesn't jump out to you what the performance has been over the last 2 years, because all these stocks, start down here and they go here. So no matter how fast they're growing, they all look like if they're growing at a 45-degree angle. And so I created this thing over here that sort of normalizes it, is that it'll actually report back what that growth is and by the year. So TTD, okay, and you can imagine that when we were interested in buying it, it was during this line. But even this is at, over the last 2 years, it's been growing at 156%. So we're looking for things that are growing pretty quickly. Let's see what Tesla's doing, TSLA. Yeah, and so,
Holy cow.
over that time, look at, and so what we're really looking for, we do the top 50, and what we're really looking for are the ones that are performing really well in the last couple years. And they're
Yeah.
going to be volatile, but that's why we have our stops in place.
Huh. Neat. Thank you so much.
Okay. Yeah, and again, once we've moved the stop up, the risk has now been reduced. So then we look and see whether or not we want to buy more. And that's the thing that we have done just recently, is that we've added one more thing to help us determine whether or not we should be buying more. Let me go back to our current positions. And this is something that we're just starting to do right now, and we're seeing how it works. But for instance, take a look at apps. We've added this new one, which a friend of mine made, and all it's doing is measuring the difference between where the stock is right now and how far away it's moved from the 20-day simple moving average. And then we sort of put this line on, and the nice part about this is that you can draw on each of these charts. And we've decided that we're not going to be buying more of this if it happens to have moved quite a bit away from the moving average. And so you can see here a lot from the moving average. Maybe we shouldn't have bought it right there. Maybe we should have waited until it returned back close to the moving average. So that's an attempt that we're having of not jumping right in just because, we can buy more risk. We want to make sure that, within this area, that maybe we shouldn't be buying it this month. Maybe we should defer it to next month. And I just want to remind you, we're only doing this once a month. So we're not day trading this kind of stuff.
No, that's a good point. That's a good reminder about the once a month thing.
Yeah.
Good point. Thanks.
Okay. And let's see, is that all I've got? I think that's all I've got. One sec.
All right, great. Thanks,
Yeah.
Brian. Excellent.
Okay.
Wish
Thank
we
you
could
very
see you
much.
again.
Yes, I went out and even bought this USB camera because I'm working from a desktop. And of course, the desktops don't come with cameras. So I went and got this USB thing. And it seems to be working on a different computer, but I plugged it in this morning on this computer and no such luck.
Oh, shoot. All right. Well, we'll have to keep our fingers crossed that you can get it together for the next meeting. Oh, by the way, this meeting is 1 week ahead of where it's supposed to be. I made a mistake, and it recurred several times. We usually wait until the day after the monthly options expiration, which is next week. Somehow or other, I entered it multiple times, multiple places for the week before. So I am sorry that if we're a little bit ahead of the game, but good to see we've got a good number of participants, 54 participants, and we were able to get the program together here. All right. All right, so you should see the agenda here right now. And I wanted to, so let me start by just doing a little bit of stuff with Tushar's. So I had quite a number of conversations with Tushar the past month. His presentation stimulated just tremendous amounts of thoughts from my part. And but I'm trying to understand his thing in more detail. So you should see a PDF file that I have here, which can you guys see this? Yeah, just say yes.
We can see it.
Okay, cool. All right. So he had, the way he explained it to me was that he had a portfolio, and he had 50% of it was in cash and other investments. And then he had 50% of it he applied to this trade often, trade small strategy. And what I wanted to find out is I'm really concerned. If it sounded really good, and I started trading it, but I also wanted to know, okay, if there is a black swan event, he's trading individual stocks. If there's a black swan event, what's going to happen? But before I get there, I wanted to make sure that I understood his fundamental strategy. So he has a bull side and he has a bear side. And so on the bull side, he has, if you say 50% of his money is in this TOTS strategy, 17% of the entire, this is 17% of the entire portfolio, is bull risk. And then he has some bull margin on it, and then you have the bull premium. So if you go through these things and you say, okay, this is what you would typically see in his, as a result of this, of his putting on these various bull or bear spreads. So it looks like he gets out with a 50%. If he gets 50% of his gain, he just gets out. He's got a limit order in there for a 50% gain. If he, on either side. And then if it goes that much against him, he gets out. He said that he had an 80% success rate. So I put that into this calculation here. And so if you look at the expectancy, you say, okay, 80% times the amount of money you make on the plus side, and you got to subtract off the 0.2 times you lost. 20% of the time you're losing, and you're going to lose about that same amount. So you go through this and you find out that his return on capital net is about 3.6% return on capital every 10 days. You know, that's really, really good. If you can consistently do that, that's outstanding. So in the end, it should imply or come to about a 357% per year return on capital. So outstanding, absolutely outstanding. But my question is, what happens if there is a, you don't want to lose everything when you have a black swan event. So I created a follow-on chart to that. Here is this black swan event. And so what what happens in a black swan? Well, you lose your bull risk. So if it say it's going to go down, right? The market's going to all of a sudden just crash. And so you lose your bull risk, you lose your bull margin, and you end up with the bull premium, and you end up with the bear premium, and your bear risk is good, and your bear margin is good. So anytime you're doing a bear trade here, you're saying, okay, the market's going to go down. Well, he's actually balanced it. He actually put the same amount of capital towards the towards the bull side and 50% towards the bear side. Really cool. Very, very nice. Very tedious. I actually started doing this strategy earlier this past month. From the time he made this presentation to what I found might be even better, I thought it was pretty good. And if you look at this, when you add this all up, you only have a worst case loss for that 10-day period of about a 10% loss. That is fantastic. The market can go down 30% and he will only lose 10%. My kudos, applause. I wish Tushar was here. I'll have to send him the video so that he gets his kudos from it. But I thought that was a wonderful, wonderful finding. So I've actually started using this more and more, but it's extremely tedious, difficult for me. I can't handle the huge number of option trades. I only had five stocks, and it was beyond this mortal's mental ability. So, all right. So that's what I had. Steve, are you back up and running or not? So that was the follow-up that I had here on trade often, trade small.
Hey, just while you're on that, Ken, this is really great that you kind of, summarize the risk, because it's something that, wasn't really clear on what how this strategy could affect growth. But, the nice thing, I think what you're showing is you can scale this up or down based on your personal risk tolerance. I mean, and in theory, with a cap at 10% gross loss, if you really wanted to use all your cash, let's just say, and you were into this level of work and tediousness, you could just double that and go to a max black swan loss of 20%. And for some people, well, if it's really bad, then that's not really that bad a risk. And you essentially double what it is, because you have that 350% ish annualized, but you're only using half your money. So if you double it, I mean, you're really, past the 700% range.
Yeah.
If you're willing to manage it tightly and use your entire portfolio. I mean, that seems a little crazy to me, because it's kind of a little opposite of what I see, is use a smaller portion of your cash for higher leverage and, making bigger gains that way. But, for somebody who really wants to do that, it just shows you, well, in a good year, sure, 700+%, right?
Yeah.
So if you want to do the work.
Yeah, exactly. And what Tushar was alluding to is he was saying somewhere in the neighborhood of near 100% per year is what he was getting. I wish he would be online so we can confirm that. But I will this week when I send out the link to this video and see if he concurs. So, but this is my take on it, and I thought this was pretty impressive. And after doing this, Grant, just like what you said, it's like, yeah, you could put your entire portfolio into this thing. I didn't see any, and I don't know of any particular thing that would cause it to explode, to basically just wipe you out completely, which is really, really nice. I really like that idea. And the next part of this presentation is going to go deep into the pool here, and you're going to get into wow, what?
Ken, this is Kirk.
Yeah, Kurt.
Hey, I just wanted to share real briefly that I don't have a full and comprehensive reply to this to Shar's options trading. I tried an experiment with it for the last month.
Yeah.
Since his last presentation, and I'm having difficulty getting to that level. And all I can say at this point is there's a lot more to filtering the stocks that he shares from his scan through his dedicated study that I still don't understand enough to stay away from those with losses. And I'm certainly not to the level where I'm seeing that kind of results.
Okay.
And it's taking a lot more time than I had hoped. I had hoped to have something that was perhaps managed an hour a day, but that's not the case. So those are my two cautions at this point. I'd be happy to provide more details at some later
This
date.
is great feedback, Kurt. I concur with you. And so do you have his FTM simple indicator that I have here on the chart here?
Roger that. I have
Okay.
it with the K stochastic and I have it with the TTM squeeze just to compare.
Okay.
And
And are you able to see the 80 percentile success rate or not?
no, I have not.
Okay.
That may
Yeah.
be me.
Well,
and then you got to go out the 50 days and stuff like that.
My average hold time is much smaller.
Well, your hold time is small, but your time frame, the options expiration is he's talking about 50-day options expiration.
Yeah, when I spoke with him, I've been asking questions directly to him.
Okay.
I've been
Okay.
using 38 to 65,
Okay.
and I know there's been a little perturbation in the market. Perhaps that's an indication that shouldn't be extrapolated over the overall results based on the last year. So there are other factors there, and that's why I'm not really prepared. I just wanted to provide a caution that for a newbie,
Yeah.
there's just a whole lot more going on in his custom study that somehow I asked how many on average he takes every day.
Yeah.
Out of his list, and his number he said to me was 2, and that's much less than what I'm taking based on his indicator. So there's other things going on, and I just wanted to caution others. Okay.
Yeah. The number one issue that I've had is the liquidity. And that's what we're going to get into in the next part of this my part of the presentation here. Liquidity is a major issue. I have traded 100, 200 contracts at a time, or verticals or iron condors and stuff. So when you start talking about that kind of stuff, you really your selection, the number of stocks that you can use is extremely small. It would be good to see, Kirk, if you had some sort of a list of the stocks that you picked and see where they what caused you to enter them and what caused you to exit them. I don't know if you could show that quickly or not.
Ken, I could barely understand you. You're so much static.
Oh no, not again. Shoot. I'm trying to see why is there static on this thing.
One thing about just the past month, I guess somewhat in defense of Tushar's broader strategy, is that I don't know if his what he calls purple rain indicators kicked off, but I kind of thought it was a pretty easy to identify volatility VIX squeeze and the pop that happened subsequently. I mean, I don't know. I don't use any real technical indicators, but I picked up on it. And I think, if anything, maybe his indicator could be tuned up to be a little more sensitive if it didn't really show that.
Hey
what was
guys,
it from the other week?
hey guys, can you hear me?
Yeah.
I am fairly familiar with Tushar's TSTO strategy. And a big piece that we haven't been talking about is when you're looking at every day the signals that you get, you don't just take the signals. You really need to look at the market profile and then try to examine, where the stock is moving, and then see if you want to partake in that move. And that is more than 50% of the trade, actually maybe 75% of the trade. And that's the part that kind of needs to be looked at. And that's why Tushar is very successful, because he's a genius in reading the market profile. And you can't just replicate that by mechanically taking his every trade that gives you a signal. I did not find that to be a good strategy.
Got it. I see. Yeah. Okay. Good. Good point.
Yeah, but there is gold in those mountains, and if you can combine it with the market profile, you will make money, because I know Tushar does.
So the market's basically been going sideways here, right? So I'm looking at this and I'm trading my holy grail, and everything seems to be just making a little bit of money here and there. Yeah, it's going up and down, up and down, and up and down, and up and down. But it's just lots and lots and lots of trades. And I'm thinking, how can I get more money out of this? But it's going sideways, but then you have a breakout here. So I want to be able to figure out a way to make money in this sideways market and in the breakout. So how much money can I make here? That is the big question. So I have a goal and a set of objectives. My goal is just to make money, as much money as I can, make money sideways as well as the breakout, and it has to have a positive expectancy. It has to produce the best possible return on capital. So, the holy grail, yeah, it's got a positive expectancy, it makes money, but the return on capital, maybe make a 0.5% or less per day on my capital, and I'm throwing a large dollars at the problem, right? And I also want to protect from a black swan event or a shift in the market, say a max downward thrust of 30%. So I don't know what other people are seeing, but for me, that's my threshold. If I see a 30% drop in my net capital, I am in pain, extreme pain. So, and I'd also like to do it as a automated trade, or what Steve Alexander and I have been calling a ballistic trade. So in order to do that, you have to minimize the human interaction, and you got to make it so it's manageable by mere mortals, right? So here is a thing that I put together. I call it the BBIC. It's Bill Burmeister's Iron Condor. And Tim Sire came back and he was saying, well, what does BBIC stand for again? Is that the big boys Iron Condor? And I like that too. So it basically is the idea is to basically make money. So this is pointing at the long call. This is a short call. This is a short put, and this is a long put. So if the Iron Condor, it basically makes the most money if it goes right down the center. So this week, the week of 419 to 423, that basically went right down the center and you get maximum gain. Here's another one. You go right down the center and make maximum gain. Here's another one. Well, it went down and it violated the Iron Condor, but then it came back up and put it back inside. But the way the BBIC works is that when it goes down, it actually buys back the short strike and then allows the long strike to continue on. So here is a summary of what it looks like. I look back because of Tushar. I was able to go back and look at the prices of the various strikes. So I the software that I wrote actually comes up with the long strike, the short strike, short call strike, the short put strike, and the long put strike. And I look back, this goes back over a year. If you can scroll way, way, way down on this thing, you can actually see it goes back a year. And it collects, it shows the premium. So this is the week. This is the week ending this time. This is the spread. So if you look over here, it's 426 to 421 are the two strikes. So there's a $5 spread there. And at 415 to 412, that's actually only a $3 strike, right? So, but the worst case is the $5 spread. And on this particular one, you can collect $147. So if you look at the reward to risk, you end up with 41% reward to risk. That's good. And if you look at the capital that you would get on this is a 29% return on capital. That's pretty good. So if you're looking at this in terms of a week, you have 1 week and you make 29% return on the capital you invest in this BBIC. To me, that is awesome. So I went back and I looked and I found there were times where the BBIC was violated. It violated either the short call on the top side or the short put on the bottom side and actually posted a loss. So here you collected a premium of $165, but in the end, you actually lost $166 on a $5 wide spread. So you actually lost 33%. So you put all of these pluses and minuses together and you end up with if you start at the bottom here, you said, oh, you're going to take all your money, you basically invest it. So you're going to take $10,000 or whatever. Here, I started with $10,000, you invest it, you make 30%, so you're up to $13,000 on this week. And then, okay, you're going to only end up with an 8% over the $10,000. So you're going to lose money here. So it started with 13,000, you're down to 10,800. But you're still better than the 10,000, right? So you go through all this and you can actually do compounding on it, and you can find out that lo and behold, you start with $10,000 over the last 6 months, you will be up to $134,000 in 6 months of time. And it didn't matter whether the SPY was going up or if it was going down, because you were able to compensate. And now I'm going to talk about how to do that, what it actually does, what the BBIC really does, what's the internals there. So this is just a plot of the gains. So you can see you start up with the 0%, and you finally got up to a 1,200% gain over 30 weeks. And then the next big aha to me was this looking at individual gains. This is the individual gain or loss on each week, looking back 30 weeks. And I plotted over this, I plotted the VIX. Well, where you lose consistently on this is when the VIX shoots up, right? So here's a loss. Do I know the VIX is going to shoot up? I don't have the crystal ball. I have no idea, but it could indeed shoot up. So what I want to do is I want to figure out how I can take advantage of this, turn this loss into a gain, right? But even with these losses, the BBIC makes money through thick and thin on SPY, and that surprised me. I had no idea that you could basically trade SPY and just make money trading iron condors on SPY. So I created this indicator that tries to tell you when you have a positive Vega trade and a negative Vega trade. I know this is going to be probably pretty esoteric for most people here. Hopefully the people in the stock rooms or the futures rooms aren't they don't have to listen to this kind of stuff. But anybody else here, hopefully they are fully appreciative of the Greeks in option trading. So I created this indicator that basically looks at the slope. if the slope is down in the VIX, you have a negative vega. So you have negative vega trades when the VIX is going down, and you have positive vega trades when the VIX is going up, right? So here are different vega trades, right? So when the vega is negative for the whole market, you want to basically short calls, short puts. You basically want a premium. You want to be selling premium. Here is the iron condor, right? The iron condor, the BBIC is down here. Now, when the vega is positive, you want to be long calls or long puts, or long straddles. So you want to be basically buyer. This is a buyer of premium. But what's unique about the BBIC is that it automatically switches from a negative vega trade to a positive vega trade. That is the unique feature of the BBIC that makes it a viable long-term growth strategy. Hopefully people are getting this. I will go through and I'll show you what actually happened. This is the week of ending 4/30, and the market is basically going sideways. And as you know, as everybody knows, this is SPY. These are the iron condors on here. This is another iron condor in the following week. This is the price of the option that I chose. Or actually, this is the option that I chose here. So these four are the options. And this is an indicator that basically looks at, okay, I went into this option trade at 8 o'clock in the morning, and I had the potential, I collected premium of $146. And as long as it goes down the center of that, you collect $146. Now, if you look at the spreads, they're about $6, $6 or $7. Here, let's see, 21. So it's about $6. So if you take 146 divided by $6 or $600, that tells you what the return on capital is for that particular trade. Now, here's the real key to the BBIC, was when it switches. It switches from vega trading from a negative vega to a positive vega. So here is the BBIC money. It's basically the price is just going right down the center of the channel. It ends, you get maximum gain. This happens 2 weeks in a row, right? Right down the center of the channel. Then next week, you look at the opening price and you say, okay, I'm going to just do it about that opening price. I'm going to put on an iron condor, and it's going to go up and down from a starting point. Well, at this time here, it violated there's a midpoint. You basically go from a negative vega to a positive vega when you are halfway between the short strike and the long strike. And it's switched here. And if it's switched, that's maximum, was one of the maximum losses for the BBIC. And then if it went back to the north here through the call side, that would be a terrible thing to happen. But this particular one just shows how when it goes through and it keeps on going down, you make money like crazy on the put side. So you basically exit down in here. This was earlier in February, so I didn't take this trade, but this was just for illustration purposes, just to show how the thing trades, how the BBIC switches from a negative vega to a positive vega trading. And here is the actual trades I put on. This was May 3rd. So I put the trade on May 3rd, and it was going down the center of the channel. Everything is cool. Next day came along and it violated my channel. So it exited. So I had the first one. These are two profit curves here. This is the profit curve for the iron condor, and this is when it switches to eliminating the short put side. So here is the loss. So I basically had a $36 loss on the iron condor. It sold out the put side. I mean, it bought back the short put, and then I ended up getting a the resulting option strategy could have made $128, but realistically what I did is I waited a little bit too long. I started waiting for the thing to come down a little bit more, and my stop was down, and I only made $86. So the net result is I basically made about $50 on that trade. It's not a lot of money, but it's, you know, anytime you can walk away and make money on it, this is a good thing. So this is live trading results. This is the May 3rd to May 8th. I actually exited on May 4th. So I made a $50 net profit on a $4 wide spread. And then if you take a look at that, so that's $50 over $400. So the return on capital was 12.5% in just 2 days. And here is the trade. Here is what actually happened. You could see what happened on that. This was the May 3rd to May 8th trade. So it went down. It got me out here. I made money because I exited my long call position here. I mean, my long put position. And then the rest of the week, I didn't do anything. So it was just like, okay, that's it for the week. I'm done. And then May 10th, here's another one. And this one here, you can see the spreads are wider, but the premium collected was $155. But when I exited the long put position, I actually made another $275 on it for a return on capital of 107%. Outstanding. When you go into an iron condor and you think you can only make $155 and so 20-30%, and you end up making 107% return on capital. Very nice. I like that.
Hey Ken, didn't you have to buy back the short put though on that one?
I did.
Where was that? Wasn't in your formula.
No, it's twice. You see it happen twice.
On the May 10th.
So,
no, go back to the.
So this is what was happening here. I had to buy the short back here.
I know, but no, I'm talking about the second trade on May 10th.
May 10th.
May 10th, May 15th.
Yeah.
You get 155 plus 275. But where's the minus where you bought back the put?
That was the result. So that was in. I'm going to show a calculator that I came up with to actually show that in detail.
Oh, okay.
So it was actually I
The 275 is your purchase price, purchasing the short put back, and plus your profits on the long put.
Correct.
Oh, okay.
Yeah. I'm going to show that in a spreadsheet that I did. As long as you're asking that, let's see if I can show you that here real quick. Well,
Okay. Thank you. That's okay.
Yeah. All right. I'll show you that in a little bit. Okay, Scott. All right. And also I could use feedback if there's a better way of showing that spreadsheet, but this is just a summary, right? So I'll go to details more there. So money management is key to the kingdom. That's from Larry Williams. He said, good successful traders find that 90% of their profits come from effective money management. If you're not managing your money effectively, you know, you're not going to get anywhere. So it's a good way to really accelerate your profits. So for me, I did the same thing I did with the two SHARs thing, and I said, here's this BBIC, but instead of, when I went through this whole thing, it said, I got to be careful of a black swan. But let me just go through this really quickly. I got a small portfolio. I got 100% of it's going to go for the BBIC, and I've got 60 to 80% of risk depending upon how much premium you collect. And the net result is you end up 70% of the time you make 19 to 38% of the original portfolio. You don't quite get all of it back. There's some, if you want to close your trade on Friday, you want to make sure you close it, and you may have to, you may not get 100% of your expected value back. Bill Burmeister usually goes to the end, and he collects every penny. He lets these things expire worthless. I'm not quite as aggressive as that. And so I gave a little cheat here. So I'm only going to go 19 to 38%. So if you look at a low return on capital for this calculation, you got 70% of the time you're making about 19% on your portfolio, and 30% of the time you're losing about 20% on your portfolio, right? And if you go through these calculations, you end up with a 7.3% return on capital net every 5 days. Annualized 3,800%. Not bad. So so basically 52 weeks. Every 52 weeks you make about 7.3% on average. I'm going to go through it. I can show you some actual real numbers
Hey, Ken.
Yeah.
I have a question. So does Gary. I'll ask Gary's question first in the chat. He said, for the BBIC adjustments, once a short is bought back, will any further adjustments be considered, or do you ride to expiration? It sounds like you will exit early sometimes.
Yeah, and I'm going to show that in this other spreadsheet that I have.
Okay.
To see that I actually exited. So if you don't have very much left on the call side, on the short call side, I get rid of that. You know, if it's less than a nickel or a dime or something like that, I get rid of it. I do leave the long call side on though. I haven't found any reason to get rid of the long call, because if for some reason something bizarro happens, I can actually collect a good premium on the long call side, so I can make, you know, whipsaw thing happen, that kind of stuff.
Yeah. And the question I had was, are you, like, when you're looking for that midpoint to, you know, to cover your short one back, is this something you're watching intraday, or do you have like, how do you execute? Do you have like alerts or conditional?
So I have so this is being done on SPY. Liquidity on SPY is phenomenal.
Oh yeah, it's the best.
When you are, I'm going to show some of the details of the liquidity on SPY.
It's the most liquid stock or ETF there is. Yeah.
It's most liquid stock, most liquid options. It's wonderful. It's a penny wide spread. So what happens is that I look for the midpoint. So if it's a 400 to 410 vertical, I'm gonna trigger at 400 to 410. I'm gonna trigger at 405. So that I'm gonna look at SPY, and it says if it hit 405, then I'm out of the short side. Just get me out of the market.
Right.
Okay.
And then I'm just, again, I know I've gone over the mechanics of the BBIC a while ago. I'm just trying to refresh my memory. How do you choose your strikes? Is it based on the like, are you doing one or two standard deviations, or like how wide the spread? How do you decide the width of the spread?
I'm going to go into that.
Okay.
Okay. Yeah.
Thank you.
All right. Yeah. So, but what I wanted to do here is I wanted to say, well, what happens with a black swan, right? So I am definitely afraid of a black swan. Now, I've had a conversation this past week with Steve, and his suggestion was, can black swans where you open up overnight down 30% don't happen? And sure enough, I look back, 1987, I look back all different places, and it never opened, it never gapped that kind of distance. When you've got all of the S&P 500, you might see some of them going down, but it's a gradual decline. So this would be a worst case scenario. If you would apply this to an individual stock, you could indeed see a 90% loss in the value of the stock overnight. But when you're talking about SPY, this really doesn't happen, which is very cool, very cool. So, but I just put it in here for completeness sake. And I said, what happens if you see a black swan? Well, you could indeed lose 80%. You could have an 80% loss using the BBIC if something like that, some event could happen in an overnight event where you can't actually buy back the short put. But it's still okay. You're going to see something here that's just blows me away. So in conclusion of this part of it, choose a strategy that automatically adjusts to make the market conditions and direction. The BBIC is the best one I've found so far. and it makes money going sideways. It makes money going up, makes money going down. It is wonderful. And it's nice because it can be automated. I've automated all of the calculations and putting in all of the trades with TradeStation. But this past few weeks, I've actually done this with real money on the Thinkorswim platform, and it's doable. As long as you don't have to. Tushar spent a tremendous amount of time looking for the right opportunities and stuff. The opportunity is there all the time. Just trade SPY. Don't worry about anything else. If you can make 20% return on SPY and it goes sideways, I think that's pretty damn good. So Scott had a few good questions here. So I'm going to go into those. Just before I do that, there was a question about, okay, here is this return on capital, right? And you see these losses. These are losses, and you only got 2 losses in a row. And so somebody asked me, well, what happens if all of those losses, you go into this trade and you have these losses, all of them right off the start? What happens? So here is, I can answer it real simply by just saying, go back to your high school. You know that multiplication is a commutative, has commutative properties. And for some people, that makes complete sense. Go on to the next page. But some people don't understand what that is. They forgot their high school math. But if you look at this and you say, let's sort these things, and let's sort them so that you had all of those losses right up front. So this shows all the losses right up front. So you start with $10,000 in capital. You end up going down to just about $800. So you had every one of these losses, and then you had all of these gains, all of this thing happening. So what you end up with is there's rounding errors. There's some other things going on here, but for the most part, you end up with the same return on capital because multiplication is commutative. So just for those that didn't remember their high school math, it works. So I'm going to go through some of the stuff that that Scott was talking about here, asking questions about. If I missed something, Scott, feel free to chime in. But these were trades. These were actual trades. So these are actual trades here. These are actual trades on not the right dollar amount. I didn't put $150,000 up for this. Okay, I was just using one contract. So I'm trying to experiment with this thing right now, right? So this particular trade was on TradeStation, and this is on Thinkorswim. So TradeStation, I had a $4 wide spread. These were the strikes that I chose. And TradeStation does this computation automatically. It uses a standard error calculation of the previous week, or you can look back 2 weeks or 3 weeks or whatever. So it uses a standard error. It figures out what's the probability of one standard error, and that's where it says, okay, you're going to have your short strike at one standard error off of the initial price, and then you'll have the short put one standard error below. And then you take so you got 2 standard errors between those two, and you take 2 standard errors, and that's where you buy your long strike, your long strikes on both sides. But I did something a little different here on Thinkorswim. I didn't have that flexibility to be able to do all those calculations. So what I said in my favorite is always the 30 delta. So I basically chose a 30 delta on this TradeStation or Thinkorswim account, and here were the strikes that were chosen. So Scott, when you open up on Monday, you wait till the market settles down, 7 o'clock, 8 o'clock, whenever is a good time for you. And then you look for a 30 delta. So this was a 30 delta short call, and this was a 30 delta short put. And then I looked up so I'm trying to find out $4, $5, kinds of nice number. And then I took a look at what's the delta on that, and it ranges between 0.1 and 0.2. So I was happy with that. And when I look at the premium I collected of $155, that's pretty good. So the risk reward is 63%. Not bad. That's pretty decent. If you look down here, you could see that here's one of them where the spreads on TradeStation were $24 spreads. So that's $2,400 on the spread. And I only collected 5% the risk, the reward to risk. Very, 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 very small. So to me, this is, you don't want to go down this low, but I did it just to see if it would work. And here are the strikes. So I believe I will have this spreadsheet up on my website at the somewhere in the next few days. So if people want to validate this, check it out, make sure that it all works. If somebody has any problems, they see any problems with this, please let me know, because I am planning on putting more and more and more capital into this thing. I would like to know that it's not going to work before I do a lot of capital. Yes.
And I have just a comment. So that spread in November 13th, that's interesting. So that was election week or the week after election. So that's why the VIX was spiked.
Yeah.
And it may be just a week you don't even want to trade this thing.
Right.
Because you know the
Yeah.
VIX is spiked and you know it's going to come down once election's over.
Right. And where you make really good money is when the VIX starts coming down, right?
That's
But
true. Yeah.
what I wanted to do was I wanted to see what would happen if those things happen. You can see the previous week that it actually caused grief. I mean, there was a significant loss, well, 20% loss, 45% loss. So there were several losses before that.
Yeah.
But this gives you an idea of the spreads you get, the premiums you collect on it, and then you can go down and you can. I even tried going out a year, and I was looking at these things when the VIX here was 74, right? Holy smoke! And then what would happen? What were the strikes that were computed from TradeStation? And so I would be great if somebody is diligent and good enough to be able to fill in the rest of this thing using ThinkBack. It was extremely tedious to do that. Maybe there's even a better way. Maybe somebody's got a way that they can use 30 deltas on the short strikes. And
I have a question on row 31 where you lost 45%. You lost 45%. Are you putting your whole account on as the max risk?
Yeah.
Because shouldn't your account drop 45% the next week?
Yeah.
Yeah, it went from 21,000 to 11,000.
Yeah.
Oh, okay. I was thinking from 11,000 to 9,000. Got it.
Yeah.
Okay, I was reading it wrong.
I got a weird question, Ken. Is most of the losses, are those from the put sale?
I do not know. Let me see what this triple star thing.
Yeah, I think you should track what side is losing.
Oh, so
Yeah, because
when I was selling iron condors a lot, I was always losing on the call side.
oh,
The market's been going up for 12 years.
Yeah, well,
Wow.
the market's been going up, and yet you still see, the market's been going up all this time, right? And if you look at this thing, you'll see that most of the time you're making profit.
well, because you're selling outside of the. I mean, things don't jump up as much as they fall precipitously. They go up slowly. So you have that.
Right.
I mean, that's where this whole opportunity is. Because I have a long side bias, and in general, I don't sell puts like ever. So honestly, a lot of my trades look more like after you bought your short side put back, and so I mean, to me, it's like, well, what happens if you just don't do that?
Don't do.
You don't short the put. I mean, that's totally different strategy.
Don't short the call side, right?
Right. It's like a collar with a straddle strangle kind of attached to it. To me, it's a very simple thing, and I manage it a heck of a lot less than this.
Yeah.
Apparently.
So it would be great to see how many people can do this. There are different ways of looking at this thing, right? And
Sure.
I really like the idea that no matter which way the market's going, if it's just going sideways, I love to be able to make 20 to 40% per year per week. I mean, that's fantastic. And then if it breaks out, then you make money, right? So this is where this is where it actually breaks out. So when you see the VIX spike, that's a breakout. And what happened was with this simulation, with this back testing thing that I did here, you actually see losses here. Well, now I have with the switching of from the Vega, I can actually make money on these. So I would have made money on these two strikes. I believe I would have made money here. I believe I would have made money here, and not here. This was the only one that I couldn't figure out why. There was nothing I could do to prevent losing money. That was just an anomaly. That one went through, I think it was, like you said, the call side, Grant, but it gapped through the call side. And so that was a major loss. But all these other ones should have been all wins.
Okay.
So
I think that was more Scott's point. I'm bad at doing that. I usually take it kind of, you know, like yeah.
Why should all those be wins instead? I missed that.
the reason they should all be wins is because the strategy switches, right?
Yeah, right.
So the strategy switches from a negative Vega to a positive Vega trade.
Right.
Right. So it's basically switching from an iron condor to a long call or long put.
Right.
So that switching function is a way to mitigate and actually make money on that on those
But isn't your spreadsheet? Aren't those BBIC trades? Or you're just selling condors and doing nothing?
I tried. So I tried the best I could using the I'm using the Thinkorswim platform. I'm using the TradeStation platform, and this was the best estimate I could get as far as the P&L and stuff. So, you know, somebody else may look at this and they may come back and say, no, you could have made this much money. You could have done this or could have done that.
But are these P&Ls based on doing the switching, or it sounds like they're not? There's no switching going on.
Yeah, there is. But sometimes what happens, it switches and then it goes right back the other way. So if it doesn't continue on that path, it switches and it just enough to take out your short strike, then it goes the other direction, you've lost.
Right.
That's a loss. So some of those happen that way. But
then how would you avoid that? If you said you avoid that by switching, but now you're saying these conclude switching.
No. Some of them, only some of these things didn't work. Only some of these things went to down to the short strike and then violated it and then came back to the channel again. Those are the losses. That's in my view, that's a guaranteed loss if I have one here. So if this thing came down, went out the short strike, and took out the short strike, and then went back into the center of this channel, that would have been a loss. I don't have.
Just buy some options, some SPY option data, and you actually do it.
Well, I don't have to. I've got 4 years of option data on SPY, but it's just writing the software to do all that.
Yeah. Is it in CSV or is it in CS? Can you put it in CSV format? And I could put it together, put something together for you.
Yeah, I could pack it into a zip file and put it up on my Google Drive.
Yeah, I'd be interested.
Ken, most of these are weekly that are initiated on Monday, 7, 8 o'clock.
Yep.
Can I make one suggestion of something you might want to throw in that could, in theory, be automated? Is sometime like Wednesday, Thursday, you buy another straddle strangle position kind of late in the week, and it'd be an overlay to this process, but you're already trading these things, and it's like, I don't know if it could just automate it, and you squeeze a little more about the late week price action, because in theory everything's cheaper, right? And then you use, and maybe you only do it when you have gains. Maybe you only do it, it's automated in some way where, you have a trigger and you buy that. Again, I'm thinking it's like a Wednesday, Thursday thing, and you overlay that, because there's almost always tail end of the week action. And there's part of me that thinks, for me,
let me show you what it looks like.
Okay,
I
perfect.
did exactly that, Grant.
perfect.
Yeah. Oh, dang. Do I got it here or not? Let me see if I got it. I didn't get it. Darn it. Darn. I did that. And so this trade here was done on TD Ameritrade. And so what I tried to do is I tried to initiate a trade on Thursday. So the first trade was exceptional. The first trade of the week was really good. And then I said, you know, I'm going to be sitting on my hands for the rest of the week, or I should be able to make some money this week.
Exactly.
And so I said, well, let me put on another BBIC. So I tried to do that on a Thursday, and it proceeded to nail me. It nailed me in
Yeah,
one
you don't
direction.
want to sell anything. No, this is when I mean, because this is you don't want to sell. You're not collecting premium to the end of the week. That's why you put on the strangle.
A strangle, and then see if you make
Yeah.
money on that side.
Yeah.
It would have worked. It would have worked this past the previous week. I'm trying to figure out if I got.
Oh yeah, most of those. I mean, it often would. I'm just wondering how many times if you just did it automated, and you put no brain power past it, if you can kind of tune it up to where it just most of the time makes money and most of the time enhances your profits.
So here's the goofy ass trade. So I made this is the week 2 weeks ago. It went down. I made money on this one since it violated the short put. I left the long put in there, and I actually exited the long put, and that was a moneymaker. That was the $50 one, right? And then I'm sitting here Wednesday. It's like, hey, you know, I sit on my hands to Monday, or should I do something? So I said, okay, Thursday I had the brilliant idea. I'm going to do another a BBIC. I put it on, and no sooner I put it on, it violated it, and it went up. If I would have gotten out, I would have been fine. But no, I thought it was going to keep on going. I waited through the weekend. It turned around and went the other way. And then it went the other way with a vengeance. So I ended up losing on that trade on the short side. I lost on the long side. And actually, I lost on the long side, and then I lost on the short side here. So that was the worst case scenario. And that was this one here. So I lost on the short call side. I lost on the short put side. And then here is the long put that I finally closed the trade. And I was down. I was going to collect 216, and I ended up losing 433. So I was an 86% loss. That ain't going to happen again.
Yeah. Wow. Well, yeah. No, that's why I don't. Yeah, you don't want to be selling stuff that late in the week.
Yeah.
To me, I think if you know a fairly tight, almost straddle, could have served you better right in that moment. Because it's tightening, like you see consolidation. So, Monday, Tuesday, Wednesday, it's consolidating,
Well, it wasn't consolidating.
Well, I mean, sort of.
Friday.
No, not right before that. So right there, right where you got the cursor right there, just, that's a consolidation wedge, and right to, what is that, Monday, Tuesday, Wednesday.
This is Monday, Tuesday here. So it's a Tuesday.
Yeah. So Wednesday, Thursday, it's consolidating between the 4 days. Yeah, it depends where you see it, where you're looking at it.
Yeah. So anyway.
Okay.
So that was. Let's see. So did I finish that? Let's see here. Okay. So all right. Okay. Cool. So that just shows you the other thing. So is there something else that I missed on that, Scott? No.
I don't think.
I don't know if you have any other questions. Oh, this is the template that I'm using, Scott. If you have, or anybody else in the group, if you have any suggestions on how to better look at your net on any individual trade, this is what I've been trying to do. And so I got this initial date, the current date or the end date, and then I have an initial price. So I have all of these are the initial price, and then this is the net price, the premium that I'm collecting on it. And then it shows the exit, the short. And I usually have a date here when the actual short, exiting the short position. And so I end up totaling all of this, and that comes down and becomes the net here. And I add these two together, and that comes up with either a win or a loss. So if somebody has a better, and here's the strikes. So if somebody has a better format, people that do options trading and they want to track their individual iron condors, verticals, what have you, I would be interested in seeing what they use to track them to see if you are making progress or not making progress. And then I use, of course, this long thing here, which is tracking all the trades. So what you can do then is you could say, okay, how many periods were there? There are 32 periods. During those 32 periods, what was the mean compounded gain? So during those 32 periods was 11.28%. So 11.28% is what I was making per week when you figure all the wins and all the losses. And what I showed in that that chart with the iron condors in that previous presentation was that I was expecting about 7.5%, but that's kind of a worst case. That's kind of a worst case scenario. So, all right. So I am going. Yeah.
Hey, this is Kirk.
Yeah, Kirk.
Real quick, I just caught your last request about how tracking those.
Yeah.
I used in TOTS, I use the real-time data command in my spreadsheets. And when you're using ThinkBack, you can capture a start, and then you jump to the end of the week for an end, and just stamp the real-time data value that you receive in the Excel spreadsheet. I'm not sure if it works for OpenDoc, but it works beautifully in Excel, and it reduces a lot of the legwork for when you're doing back testing.
Okay, I didn't follow that completely, Kirk. I'm going to go look. I'm going to go back and edit this thing. I'm going to go back and listen to that in more detail. If I have any questions, I'll give you a call.
No worries.
I'm trying to do 5 different things here at one time. So we have these other breakout rooms, and what I want to try to do is I want to try to see if I can bring everybody back into. Grant, it says that you were in the breakout room. Did you are back in?
Yeah, I just mean to confuse you. I'm logged in twice, so actually I've been monitoring one of the things and looked at. Nobody's been in the futures room, so actually I kind of just peeked around and was watching how this was working.
Oh, okay, good, thanks. Okay. But it doesn't. I don't show you in the breakout room, in the futures breakout room.
No. I left that one. I kind of went
Okay.
back and forth, and I was just looking around at what's going on.
Cool. So you can actually migrate from one room to the other room and back to the main room.
Yes.
Cool.
So if you at any time you can go back to the join breakout room. Like right now, I'm I guess back in the main meeting. You can hit the join breakout room, and if you're in a breakout room and you hit that, it'll show the other breakout rooms available.
Okay.
And you could just, hit which one you want. In this case, there were only 2. So, I could do that or leave the current breakout room that I'm in and go back to like where you are in the main meeting.
Okay.
Yeah, you can do that at any time.
Cool.
Yeah, it's pretty cool. I'm glad you tested this out.
Well, let's see what happens here. I'm going to try to broadcast to everybody to see if they can return to the main room and see if I can get everybody back here.
Okay. Yeah, it's showing that in the breakout.
It's showing that
your notice. Let's return to the room. Yeah.
Oh, cool. All right. All right. So another new little feature. I get excited about these little things. I hope that it has worked out well for everybody here. Because now what I would like to do in the last 15, 20 minutes here is to see if anybody has any suggestions, comments, and any discussion we have for what to do on Monday. So let me show one more thing here. This one here should have. So hopefully everybody is back here in the room. Yeah, cool. Looks like everybody is out of the breakout rooms. So I will close all the rooms. Cool. All right. And please, people, if you guys went into the breakout room and you guys found it useful, give me feedback, yay, nay, or whatever. That would be great. Email would be great. kenhoder@yahoo.com. And I will try to do as much as I can to make this as fruitful as possible. Let's see here. So trying to figure out what to do on Monday. There's different, everybody's got a different style, right? So we were just talking about doing things on a weekly basis, weekly options, and then some people are doing longer term things. So this is basically a market assessment trying to say, well, okay, if you're a longer term investor, what do you do? What do you look at? If you look at gasbuddy.com and you look at the past year plus, you'll see that during the Trump policies and stuff, then you have the election, and then ever since then, gas prices have been going through the roof. And when you go and look at the oil, or not oil, but the gas futures, the gas futures are doing a nice number. And so far, we've got shortages, of gas. We've got shortages of computer chips. And then we have plenty of abundances of the doses of the vaccine, and we've got lots of extra masks available now. We've got plenty of jobs. They've got so many jobs. People, I guess the administration's having a hard time convincing people to go back to work when they're paying them more for not working than they are for working. So that's kind of tough. And of course, you've heard this stuff about the people just walking across the border. So we have plenty of people coming in. Maybe they'll be starting to fill some of those vacant jobs. The relative performance. So here is relative performance of several different equities. Let's get rid of this. And you see the, here's gold. Gold and gold miners really haven't been doing anything since November. And I would have thought that that would have been going up, but it's not really doing much. And SPY hasn't been doing much. And then you start looking at wood, which is based on the lumber industry. And then QU, I don't remember what QU is. It's a future, I forgot what QU is now, but this is lumber. And you can see lumber is just taken off. It's actually doubled. The futures and lumber is actually taken off. And if anybody is looking at rig is a deep sea oil driller. And this was in November, it was down to $1.40 a share. And it has just exceeded every other equity that I've seen. So basically, they're making some good money on rig. So all the oil gas industry seems to be doing extremely well. This is iron ore, and it shows a picture of the iron ore and metallurgical coal, and it shows that as this is a supply demand curve. And what's happening is that they're basically tweaking. They want to try to get rid of coal so that they're trying to reduce demand, and they're going to end up with higher prices here coming up, I think, in the end. Fed spending, in 2017, we had 143 million taxpayers, and with an adjusted gross income totaling $10.9 trillion, and they paid 1.6 trillion in taxes. The new spending packages, the COVID was 2.4 trillion. The new proposed bills are going to be 6 trillion, and that turns out to be about $41,000 per taxpayer. And so rule of thumb, you get one for every trillion, you basically are going to pay about $10,000 additional in taxes. So I've done everything I can to minimize my taxes. I have moved everything possible into my Roth. So now the gains that I get from all the trading, hopefully I'm sure they'll figure out a way to get some of the tax, probably by introducing a sales tax or something like that. Okay, so somebody said that QU is gasoline continuous contract. Thank you, Bob. All right, so any discussion? What is your flavor for Monday? Do you guys have any suggestions for what to do on Monday from our previous options presentation? I think for me, it's kind of obvious. I'm going to be doing a Bill Burmeister's Iron Condor here. I'm going to basically be putting that on at the beginning of the week. Hopefully that I will be able to get a nice down the center trade, and you may make 20 to 40% next week. But what are other people think? Oh, I do have. Some people don't. Some people track that the rule of 13. This is the rule of 13. This is when it started. This is when it ended. You got the this is the E-mini, and it got right up to the top here, and basically it's been going sideways. So once the rule of 13 hit, it basically hasn't gone up much past that. So we're basically in a nice sideways market, which for the BBIC works really, really well. And anything else? Anything else anybody has in the group? Raise your hand, chime in with the microphone.
Hey, Ken, what's the best reference for the Bill Burmeister Iron Condor? Should I look back at I think there's a beginner's thing on in 2017?
So
if you recommend?
Yeah, if you look at the presentations and excess profits here, whoa, wrong one here. Let's see here. If you go to excess profits and you look for, if you look for ZOU, Z-O-U, and that's Joe. Here you go. 2017, 2018, Joe Zhao's daughters did that for the summer, and they made a really nice presentation. Here it is. Wait, is that? Let's see. Try to remember. Nope, that's not it. Let's see.
It's August 2017. You're on 18.
Okay. August 2017. Yeah, okay.
There you go.
So cool. So that's a really good presentation, and it was basically done by high school students, and bless their hearts, they did a great job. And you can not only see the presentation, but I also they were nervous, and I actually recorded their audio too, so you can listen to the audio while they go through the presentation. So we didn't have the Zoom technology at that time, or I didn't have it in place. So go back and check it out. Is that good enough, Bob?
No, that's great. Thank you so much.
Cool. Yeah. Yeah. All right. Any other questions, suggestions? What are you going to do, Kirk, on Monday?
Oh, put me on the spot here. Well, I'm continuing some more analysis on the Tushars spreads. I'm also diving deep into the K-stochastic there, Ken.
Mm-hmm.
I'm going to have something on that soon.
Good. Good. Yeah, I'm anxious to see how you do with that. Always up for improvement. Any others? Scott, what are you going to do on Monday?
Oh, I don't know yet. I haven't gone through my homework yet.
Anybody else got any suggestions, ideas? I see we got quite a number of people here, which is great. Anybody else? Let's see here.
Hey,
I'm
Ken.
I'm long gold, so I'm probably going to be adjusting some stops. And see, what else am I doing? Yeah, I'll know later. I haven't done all the weekend homework yet.
Okay. All right. All righty. Anything else? Let's see. Have I got anything else? Rule 13 policies, Jenkins cycle. I got one more thing I could show you is the Jenkins cycle. I thought was kind of cool. It basically showed we had. I can blow this up a little bit. We had this sideways market movement for several weeks here, and the Jenkins cycle is basically going flat. This is basically two cycles of flatness, and then right at the end, it fell, which is kind of nice to be able to see this thing validated, vindicated repeatedly. It basically just says once it's exhausted, it just breaks down. But then we had the other events that happened there. Let's see, what was the event?
Hey, Ken, I did have a question on your standard error.
Yeah.
Is what kind of look back
5 days.
did you use? 5 days on a daily time frame. Okay.
No, not a daily, on a 15-minute time frame.
So standard error on the 5 days, the last 50 minutes action of the last 5 days. Yeah.
Correct. Right.
On the cash session.
Correct.
Okay.
Correct. Yeah. All right. Anything else anybody's got? Any feedback on the breakout rooms? Good, bad, and different? Not willing to own up to it?
Over on the stock side, we threw out a bunch of stocks and we had Jack read them for us. I found that useful.
Okay, so were you able to share the screen, Jack's screen there?
Yep.
Cool. I didn't know that was available. Okay, good. All right, good. Good to hear.
Yeah, it might be nicer to have something to do. I'm happy to do stock reading, but I can do it on an ongoing basis too if there's interest. But it was kind of like, okay, we're all in the room. What do we do now?
Yeah. Yeah, I know. We should have had somebody that was designated as the master of ceremony, host, or what have you.
Right.
But
it would be. It's not enough to delegate somebody as the leader if the leader doesn't have a plan on what to do.
Well, that's the whole point of an open discussion. So I was hoping to be able to see people freewheel a little bit and see if there was anything that good would come out of it.
Okay.
But however it worked, please send me feedback and let me know. Since I have not been into that room, I don't know exactly what the correct. Actually, I tried the political thing. Brian, one of our senators here, has had one of these things, and he actually had me go into a room and then come out and all that kind of stuff. But they had somebody that was orchestrating all of it too. So I wanted to see how this would work in sort of an ad hoc fashion. So,
okay.
All right.
But it was good. I enjoyed it. I don't know if others did, but it was good.
Okay, good.
Ken, there are a couple of questions in the chat. There's one is, how is money flow? And the other one was, Ken, please show a chart of ARK.
Okay.
ARKK.
Sure. Okay, so let me open up money flow here real quick. Money flow. Yeah, I had a bizarre anomaly on Friday. I was watching the 1 minute bars. I was watching the money flow on SPY, and the money was flowing out and SPY was going up. And I'm like, how in the world could this be done? And what was happening evidently was a large player was basically putting in limit orders on the bottom side, and he just kept on inching the limit order up throughout the day. So the price of SPY just inched up through the entire day. And yet, when you look at it, money flow is going out. Because of the way it's measured based on the number of times you get on the bid versus on the ask size.
Yeah, the volume was about 16% lower than the average. That's a sizable drop.
Oh, interesting. I didn't know that. So here's the money flow, and we had a recent dip in the money flow for SPY. I hope people can see this here. And the Qs, money is flowing out. Dows, money's flowing out. The small cap money was flowing in until just this past day, but now we're starting to see a turn. It looks like it's turning over the top. And China is money is flowing in, and yet the price is going down. So I would expect that to turn up pretty quickly here. And financials, money is flowing in, and the TLT is nothing. And this is basic materials here on the bottom, and money is flowing into basic materials, and it's going up nicely. And this is transportation, and transportation is going up nicely too. So, all right, that was the money flow. And then someone asked about an individual stock here.
It was the ARK funds, the ARKK.
Okay. The ARKK should be here.
You were just on it. It was, you just moused over it. It was right there.
Oh, okay. So yeah, massive money flowing out of it, and the price is going down to boot. So funny, money was flowing out of it even before, in the middle of April. So, oh, I know what I got to do. People need to realize that we have this really great resource, the Excess Profits website. And if you go to Excess Profits and you go look at the calendars, you need to take a look at the events that are coming up. And so here we are. Let me close this down. So here is our meeting today. And here is a go away in May. So if you are a long-term buy and holder or want to be in the market to get you the maximum return on capital for the amount of time in the market, you can click on that and you can find out that you can reference there's a paper that I wrote. It goes through extensively and it shows how much money you can make. It's about 20% a year. You basically go away in May and come back in October. And this article, this URL will show you where it is. And if you want to click on that, you can set it to your calendar and you can be reminded that 19th is the day you want to get out of it. There's also a seasonal trade here. It's been 100% profitable on Tesla since, well, it's a 2-month trade, and Tesla's going down. I'm a little leery about it, but it's still something that someone may want to put on. And then next month, this one here is a really cool one. This is a 7-day short trade, 85% profitable over the last 20 years. If you go short on the stock market, buy puts on the 18th and then close that trade on the 25th, 85% of the time you're making money on that. And of course, there's the details in there too. So if you drill down for more details, you can find out more on that particular trade, which is going to be in June. All right.
Hey, Ken, where's the group calendar again? I can't find it on the Excess Profits site. What's the URL again?
You should be able to go Excess Profits right at the top. There's he's got 0, 1, 2, 3, 4. That's 0.
Oh, it's not a Ken.Excess Profits, just Excess.
No, Excess Profits.
Got it.
Yeah, that's Brian's claim to fame there.
Right.
He's doing great there.
Yeah. Okay. Good job.
All right.
Thank you.
Cool. All right. Any other questions? If not, I will close this meeting. It's
All
great,
right.
great to see you guys. Hopefully it all worked out, and hopefully hear some really, really good positive comments that this has worked and people made a lot of money by next month.
Thanks, Ken.
Thank you,
Good
Ken.
stuff. Good stuff, Ken.
All right, great.
Thank you very much.
Thanks.
Thank you, guys.
Bye-bye.
Good show. Keep it up.
Thank you.
Thanks, Ken.
Thank you.